It's now my great pleasure to introduce you to our presenter today, Rudi Phillipe van Dijk, editor of FN Arena. Rudi Phillipe van Dijk has been in journalism for more than 3 decades, for which the past 25 years have been in finance. After publishing his own journals and magazines in print, he successfully built up an electronic financial news service in the Netherlands between 1995 to 2000. Since arriving in Australia, he has been involved with setting up various publications and services. As founder and editor of FN Arena, he has developed various unique features and tools that today assist investors who conduct their own market research. Rudi is the author of 2 books, Change, Investing in a Low Growth World, and Who is Afraid of the Big Bad Bear. Rudi used to appear regularly on Sky Business and later on Your Money. He is now a regular guest and stock market commentator on AusBiz TV, Spot E and Switzer TV. Pre-COVID, he used to travel irregularly throughout the country to present and showcase his analyses to investors on invitation of the Australian Investors Association, the Australian Technical Analysts Association, the Australian Shareholders Association, our organisation, and others. His market observations and analyses are regularly picked up and republished by other media such as the Australian, Livewire Markets, First Links, and numerous others. Rudi, welcome, and over to you.
Thank you, Ray, and obviously it's my pleasure to be here. Thank you for the invitation. First start off is, and I'm assuming that everyone is aware with the dynamics here, is whatever I share today is very personalized research and analysis, but under no circumstances can it be constructed to be financial advice. But I think we will all be aware of that one. I'm assuming that part of the attendees today, and for people who will view this broadcast, that part of you will be familiar with my research, and you'll know that I tend to look at the share market and at financial markets a little bit differently than for most other commentators and analysts. And for those who are not familiar with my research, I can only say be prepared to be surprised. I know, in particular in 2020, and particular in the past few days and weeks, that the share market can be quite an enigma with lots of question marks that are not necessarily finding an answer in the day-to-day tribulations. But I am going to put my best effort in today to at least provide some context and answer as many questions as possible. I'd like to take it as a starting point. I'd like to take it way back to the core of what investing in the share market is all about. And I do think, on my observation, that investors and commentators sometimes get lost in what investing in the share market is all about. And I know we all try to get an asset on the cheap. We all try to find sustainable dividend supplier, and we all are trying to avoid the pitfalls and the big traps that investing in the share market involves. But at the end of the day, and whether you're into value, into yield, into growth, it doesn't matter, or into any other strategies, long-term, short-term, investing involves growth. And I think we forget that. And I think on many occasions, investors are being fed with the wrong narrative, or at least an incomplete narrative. And on my many decades of experience now, and of observations and of research, I think investors, to bring it back to the core, it doesn't matter whether you're a yield investor, a growth investor, or value investor, or any other type of investor. Growth is, at the end of the day, the cure that saves all. Right? Even if you pay too much for a share price, if growth continues or returns, then it will take care of itself. If you buy a very cheap looking asset and there is no growth coming, then your investment may not be profitable at all. And I think we should not forget that part of what investing in the share market actually involves. The second part is I took this slide from presentations I was giving a handful of years ago, and I thought it was very opposite still to repeat it here. Whatever you do, even if you don't agree with my views and with my analysis and research of the financial markets. But I think the mistake too many investors are still making today and have been making over the past 3 years is to be not flexible enough and in confrontation and facing the many changes that are happening in the world and in financial markets. And I think the key here is that you have to be flexible, and you have to be flexible enough to at some stage change whatever you're doing and to adapt to changing circumstances. And this doesn't simply apply only to the animal kingdom. This applies to everything, and including investing in the share market. Now, having said so, in the prelude to today's presentation, it was already mentioned, I've published 2 books, and my first book was published 5 years ago, and it had as title, Change, Investing in a Low Growth World. To my surprise, it has taken quite a long time before investors took on the basic principles which are laid out in that publication, and that I was really convinced at the time that I had to be careful not to wait too long to publish it, or otherwise it would be outdated. In hindsight, it turned out I didn't have to have that concern at all. Now, we have seen that the world has been changing over the past 5 years. We are still in a low growth world, and that obviously has had a big impact on how investing and how financial markets have behaved over that period. The other important element I think I put out in that book is that I believed that the framework from the past that best suited investors to look forward today were the 1920s, which is exactly 100 years ago. Now, again, in a sector that has a knee-jerk response constantly in looking back at the past and trying to find a similar pivotal period on which they can hinge their strategies, or at least gain more insights from, I'm absolutely surprised that not many people are still looking back to the 1920s. It's starting to pick up this year, I must say, on my observation, but it's still a very small group who's looking at the 1920s. So I've been saying this for 5 years now, and again, I would like to invite everyone that if you do some past research, have a look at the 1920s. We are going to look at the 1920s also in this presentation today, so I'll give you plenty of material to look into and for further research. Needless to say, if you look at this chart, the person who has created this chart, you can tell from the commentary, he very much doubted whether the 1920s are the right way to look back upon. My answer to this is that, of course, history doesn't repeat exactly day by day and in exactly the same manner as it will in the next 10 years. But the basic principles, I think, are very much similar. And there are differences. And just have a look at a few of the similarities and the differences, which I think are really, really worth pointing out. Similarity number 1. In the 1920s, we had low bond yields. Yes, we hear and we read on a regular basis today that bond yields have never been as low as today, which is true, but they were still low in the 1920s. So it doesn't have to be an all-time low all the time. Now, I've put up a chart here that shows the bond yields corrected after inflation, which I think is the correct way of looking at bond yields. And you can easily see here that all the major economies, from China to Germany, the US, and even including Australia these days, all the 10-year bond yields are now in negative territory. The importance of this, which I'm pretty much certain that you would be aware of, the importance of this is this not only has an impact on the behavior of investors in markets, but it also has an impact on the valuation of growth assets elsewhere. In other words, lower bond yields, higher valuations elsewhere. The second similarity, which we may not necessarily draw that parallel immediately, but it is there, is that the 1920s, in particular in countries like Germany that were punished very hard after losing the First World War, is that we do get the rise of populism. And today, I would argue that populism is almost, it's a day-to-day characteristic, and it's almost unthinkable that we won't have it in a similar form in the medium term. Third element is that we do get a rise of geopolitical rivalry. 100 years ago, we had the great empire of the British that was being challenged by the Germans. Today, we have the United States of America, who has for a very long time been the ruling force in the world, and they're now being challenged by China. And of course, Australia and Australian companies are now being squeezed in between that rivalry, and that this is going to play out for much longer. Just a side mark to make, I think a lot of investors in A2 Milk would be very happy now that A2 Milk is strictly taken a New Zealand company, and although it's listed on the ASX, of course. The most important element, apart from the fact that we do have exceptionally low bond yields, the most important element, I think, is what's happening in society itself. A narrative that I find very much underreported on a structural basis is that the roaring 20s came on the back of tremendous technological advances, tremendous changes in society on the basis of that. And I've put together here a few benchmark innovations that became common good in the 1920s. And you can see from the radio to cars on the road to even as little as earbuds, the telephone, of course, and we had the light bulb in the middle, because we were getting at that time the first instances of mass production and of electricity in the house. Now, we probably have to talk to someone who today is 100 years old. But I don't think any of us can truly imagine the changes in society that were happening on the back of these changes. And now to take a leap forward to today, and I've been making this prediction a couple of times over the past 5 years, the 1920s up until that point was the major change from a technological point of view and how technology would reshape society. I think the changes that are going to happen over the next 10 years will be multiple times larger and multiple times more influential. This is only the early stage. And this is definitely worth something to pay attention to, because you cannot imagine that if society is going to be basically is going to change, transform in such a significant manner, that is not going to have an impact on share markets, financial assets in general, or even on your investment strategies. Finally, of course, and this is the narrative that usually is being told about the 1920s, is that valuations on equities became very high. And this, of course, that the main reasons I would reckon is the technological advances and the low bond yields, which both have a tremendous impact. Now, a ruling narrative was, when we got to settle down share markets in February and March, is it all got too expensive, and so it had to come down. But the way that the share market has recovered so quickly, and basically pushing in relative valuations even above where they were in January, February, to me signifies that narrative was incorrect. Today's problem is not about valuations. Today's problem is that the market is very, 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 very bifurcated, in that value investing is really going through a tough time. And we do have a polarization between winners and losers. And that, I think, is going to remain a characteristic of financial markets for a long time. Now, apart from having a lot of similarities, we do have a lot of differences between today's situation and situation 100 years ago. For starters, we are not coming past a recovery from a world war, and we are starting off from a much higher level of equity valuations in the first place. But above anything, and you probably would have heard a lot about this one, central bankers are very much supporting financial assets, in that they are trying to prevent that the system collapses, and we are getting another depression, which we had in the 1930s. And the chart I put up here is it's not a, we have to use a little bit of imagination here, but what you see in the middle of it and what looks like a little bit like a few hills put together and then leading into a giant mountain. What I want you to realize is that when we were in the middle part, post 2009, the GFC, is those were unprecedented stimulus measures taken by central banks. And that was never seen in history before. Now look what happened in 2020. It dwarfs anything that has happened before. It neatly fits in with my observation that the system, despite what central bankers will tell you, the system has not become stronger or more reliable. It has actually become more vulnerable. And every time we have to save the system, we need to do more than we did before. And today, as you can see, on the very right-hand side of that, we are truly into unprecedented conditions and circumstances. It makes you wonder that if we have in 2-3 years' time a similar operation that needs to be conducted, how much we need to do then in comparison with today. Another key difference is that we had quite a high growth environment in the 1920s. As I said before, we are coming out of an extremely low growth environment, low inflation, low bond yields, lots of stimulus and low growth. In modern history, we never have had a period where the growth was consistently as low as it has been over the past, as it has been post GFC. Now, when we went into lockdown early in the year, we were going to have a global recession, and the big discussion amongst economists was, what's the recovery going to look like? And on top, you see the U, V, and the W, which are mostly debated about worldwide. At the very bottom on the left-hand side, you see the L line on its back, and that's what everyone wants to avoid. It's the dreadful L that would not reflect back on life as we know it and on the share market. But the most popular outcome amongst economists globally is what is usually referred to as the Nike swoosh. And that's at the bottom of the right. And if you use a little bit of imagination, that's a V, but with a much more stretched right-hand side of the V, indicating that the recovery will take a long time and will, after the initial bounce, will become more of a gradual phenomenon. And that still is the forecast of most people who determine a lot of money in share markets. However, as it turns out, all of the above were wrong, because the recovery we've seen is more like a K, the letter of K. So the K is the winner. And why is that? Is that because even before the pandemic hit global financial markets, we had a very, very strong bifurcation, polarization, extreme gaps between winners and losers in the market. And the pandemic this year has only increased the gap between winners and losers. And that's sort of what I try to indicate here on this graph. If you pay attention to the orangey arrows on the right, you'll see that gap has only been increasing. And what looked like unprecedented gap between winners and losers in 2019 has simply become an even more unprecedented gap in 2020. And if you want to understand, truly understand what is happening in the share market all the time, it is that interaction between winners and losers, which is essentially what the whole debate is about between growth and value. Right? A lot of market participants, and we are going through another period, which started in August and has had an extension into September, where to a lot of people in the share market, the most obvious way to allocate their money is to go into the losers, into the laggards, because they have to catch up on the fact that the winners have had all the fun up until that point. What we have to realize is that yes, we will at times will have a little bit of a period when that gap narrows, but there has to be more for the losers to genuinely catch up on the winners. And what I'm referring to that specifically is these guys have to finally start showing some true growth. either the winners have to go X growth or a lot less growth, or the losers will have to catch on to much more growth than they are at the moment. Otherwise, I think we are simply looking at a temporary phenomenon at best and a permanent characteristic of financial markets for a very long time to come. Now, another key difference is the level of debt in the world, by the way. Not death. Well, we have that too with the pandemic, but a lot of debt in the world, and we have never, and I mean never, seen as much debt in the world as we have today. And that, of course, is a byproduct of the situation in which we find ourselves, where money is abundant and very, very cheap, and stimulus provided by central bankers is very, very abundant and is remaining abundant. And what we are facing now is that a situation where after households and businesses, it will now be the part of governments to take on a lot of debt, because they have to prevent their economies from going into the depression. And that includes conservative governments like we are now seeing in Australia. I think I shocked a few accountants last week when I did this presentation to them, and I told them that if you ever think that we are going to pay back all that debt, you are really kidding yourself. We are in an era where debt will truly only grow, and that's exactly what we see in the data. One of the scarier statistics in the background, I mentioned at the top of that page, it's zombie companies. The official definition of a zombie company is a company that doesn't generate enough cash to pay off the interest on its debt over a 3-year period. According to the latest statistics, the percentage of companies that have that characteristic is now about 17 or 18% of all businesses in the world. It makes you think if we ever can get out of this rabbit hole we are in, and what the consequences might be if we ever go to higher bond yields and higher inflation. Having said so, I'm not here to scare you, I'm here to inform you. And one of the obvious observations to make over the past 5 years is basically displayed on this chart here. This question was asked 2 years ago, and it clearly shows that so-called higher valued companies continue outperforming the market average by quite a distance. And at the very bottom, the lower valued companies, the laggards, the losers, the lower qualities, and the cyclicals, and the ones that have no growth, that has been a graveyard of a lot of aspirations and no returns, essentially. Apart from the occasional attempt from financial markets to close the gap between those two extremes in the market, it remains the case that if you look into 2020, and all the stocks that reach an all-time high are the ones on the top, and all the stocks that in many cases are near the lows from 2012, if not from 29 or 28, they're on the bottom part. I mean, I couldn't help from noticing, for example, that Telstra is not far off the share price from when the Future Fund was selling its equity, and that was, I think, back in 2010. That's just one example. You would notice that the banks are a lot lower than where they were in April 2015 as well, and that in some cases not that far off from the lows in 2008. Morgans here asked the question in 2018, can this last? Well, we're 2 years later, and that same question can be asked, and that same chart would have been put up, and it would look increasingly similar to what was on display 2 years ago. Now, how does this reflect on Australian businesses? And we are fortunate enough that we just had the August reporting season, and FN Arena, one of the characteristics, one of the reasons why a lot of people like what we do is we spend a lot of time on doing the number crunching during reporting season. Now, August was just finished, and so we have some general statistics. On the basis of those general statistics, and in a manner that financial market participants look at reporting seasons, This might have been what it probably was, one of the best reporting seasons post GFC. Now that might look really, really strange, given that average profits per share were down by 20%, and dividends were cut by 36% on average. So Australia was increasingly hard hit by the pandemic. But if you take it up to how companies performed in relationship to forecasts and in relationship to how analysts responded post the updates on profits, then this was a very good reporting season. And we've basically seen that in share price performances throughout the month. Now, there's a couple of things I would like to draw your attention to here. On the top end part, we have the general statistics, and that's for 318 companies that we include in our research over the month. And you'll see those numbers look quite good. I can tell you from my personal observations, if the average target price from stockbrokers increases by 5 or 6.5%, that is one of the better reporting seasons we've seen. But if I draw your attention to the right-hand side, to the smaller column, which includes 44 companies from the ASX 50, you'll see that those numbers look decidedly different. And I think there is problem number one for the Australian share market. The head doesn't perform, the large caps doesn't perform. And I've already declared the last few years that basically the demise of the so-called blue chip investment is increasingly becoming apparent. I think investing in blue chips, if you're still doing it, you should really start rethinking that, because Australia is not following the pace of overseas companies. Somewhere in the middle on the left-hand side, you see the growth expectations for the next few years. For 2020, for 21, it's low single digits, mid-single digits. The context here is that is predominantly carried by iron ore miners. So for a lot of Australian companies, there will not be any growth, if there will be any, for the year ahead. It's all about 2022. And 2022 at these numbers is without iron ore, because analysts are very cautious in predicting that iron ore will have another year. Having said so, I do think there's probably a reasonable expectation that iron ore can continue having a good time for 2-3 years from here onwards. That's not necessarily priced in or incorporated in forecasts. On the right-hand side, I've put up a few sectors as well that should continue growing this year, next year, and the years after. Now, I alluded to in the previous chart a little bit. Australia has a little bit of a problem with the so-called blue chip old economy stocks, and they make up a lot of the large market caps locally. When I did a presentation earlier in the year, I divided the market into Class A shares and Class B, and the Class B are the laggards and the Class A share are the winners. And I thought it was quite clever in illustrating the Class B shares in how and why they're finding it so difficult to perform for their shareholders and for investors in general. And basically what I'm trying to illustrate here is that as the going gets going, they are increasingly facing themselves to be conducting their business uphill. And we all know that if you continue moving uphill, you get tired at some stage. And what ultimately happens is the levy breaks, and all of a sudden we get profit warnings, dividend cuts, and the likes. If we take a longer term view, that's probably not a bad thing at all, because it forces those boards and those companies to have another good look at what they're doing, and they have to start making investments again and reinventing themselves. In the meantime, however, it's probably not such a good idea to be a loyal shareholder there, because the share market returns might not be there from those companies. The other element that obviously has hit home really, really harshly in Australia is the fact that too many investors had become, I would use the word complacent, in terms of owning a lot of those companies simply because they were paying a dividend, and they ignored the fact that a high dividend essentially means higher risk. And as always with investments, it doesn't matter until it does. And starting in 2019, all of a sudden it started to matter. What I didn't mention when I look back at the August reporting season is that the preceding reporting seasons, and in particular February and August in 2019, were amongst the worst post-GFC in Australia. So corporate Australia was not moving into this pandemic in a healthy shape. It wasn't. Many companies, including the banks, had too high payout ratios. They invested not enough in the business, and they were basically sitting ducks waiting for bad news to hit them. And that's exactly what happened in 2020. There's another announcement I can easily make as well. When I arrived in Australia in the year 2000, I personally witnessed how some of the oldest Australian companies basically were going to the graveyard. I've personally witnessed the demise of Pacific Dunlop and of Main Nicholas. And I think we are now witnessing the demise of two more companies that have become like a household name in Australia. And I don't think they will make the next decade, and definitely not in their current shape. And the companies I'm talking about is AMP and Telstra. I think AMP is waiting to be bought and cut up, and I think Telstra is preparing, cutting itself up in pieces and selling the farm. I said it before, there are some specific characteristics for the Australian share market and for corporate Australia, but in general terms, the observation stands. We were hit a lot harder than other economies and other markets, even though our recession would not be as hard as, for example, in Europe. You can tell here from the yellow line versus the blue line that Australia was already suffering in 2019, and once 2020 hit, the damage was much larger. And this is in dividends, by the way. The damage in dividends when this pandemic and the lockdowns and all the impacts will be accounted for is potentially going to be larger than during the GFC, and that is in particular going to apply to Australian banks. If we remember correctly, during the GFC, the Australian banks had to cut dividends once, and it recovered really quickly back, and then before you know it, you basically had your dividends back from pre the GFC. That's not going to happen this time, and that is a forecast I make with conviction. It's going to take many years before we will get back to the dividends of 2018, which is basically the last dividends before the cutting started. But you couldn't make an argument that is by now also reflected in those share prices. But nevertheless, the message here is, don't think that you will see the same recovery as we saw after the GFC, because that's almost guaranteed, well, it is virtually guaranteed not going to happen. I do realize that many of you will be looking around for income, for dividends, for yields, and I've summed up here, I've lined up here 9 stocks plus the iron ore miners for the next 2-3 years, which I believe are the safest and the most reliable dividend payers on the Australian Stock Exchange now, with an incredibly low chance that they will have to cut their dividends, with the exception of Macquarie. Macquarie probably will, but it will not be massive. All the other ones, I mean, to pick one of the ones I point out here, APA Group was, from memory, listed in the same year I arrived in Australia, which is 2000, and only in 2 years out of that period, maybe 3, they have not increased their dividend, and they never cut. And I don't think they will do so. So if there is something like a dividend aristocrat in Australia, and that's a term they use often in the US for companies that haven't cut the dividends in 50 years over there, I think APA Group would be the local that wears that crown. But nevertheless, many of the others I have been recommending, insofar I am able to recommend things to investors, and in the portfolio I own big chunk of these stocks, because I do believe that dividends are important, even if in other rhetoric, but there are better alternatives around than sitting on Sydney Airport or any of the banks, or Tesla for that matter. Australia, commodities. The obvious, I mean, I've just made a few allusions to iron ore miners, and they have been great performers against the odds, one might say. That has not been the case for many of the others. I mean, an obvious observation is that while the best sector to perform post GFC in Australia and globally has been healthcare, the worst sector to perform post GFC has been energy. And I just reminded this week a few investors that the Woodside Petroleum share price in May 2008 peaked above $70. That's a 7 and a 0, by the way. And last time I checked, it was below 20. I think there's a harsh lesson in there that, in particular, those cyclicals, they do not simply increase their share price if you give them enough time. There are analysts out there, and this is from Henderson, that are convinced that we are facing the depths, the lows in commodity prices and in the attractiveness of commodities, and that we are staring towards a new super cycle. I have to admit, while that is possible on a longer term prospect, I'm very skeptical about that in the short to medium term. We'll talk about the dynamics on another slide, but needless to say that on my observation, for example, with the energy sector, is that now increasingly analysts are looking towards peak oil. And I know that most of you will still remember the last time we spoke about peak oil, it was about whether we could get enough supply to fill demand in the world. Today, analysts are talking peak oil in terms of demand. And British Petroleum, BP, who usually every year publishes a general status on the market, recently published their latest update on the market, and they are toying now with the idea that demand for oil is going to peak. In the worst case scenario, after next year, in a more beneficial scenario by 2030. Now, the problem with forecasting is that usually all forecasts are wrong, and reality will prove differently. But I still think it would be a very big call to make as an investor that you go against the forecasts made by the generals in the market, I would say. So this is a typical value investing world view, is that everything that went down over the past decade will go up eventually. It's been very volatile over the past few weeks, and after I just hopefully gave you all a little bit of a better insight in what is exactly, or what has been happening and still is happening in financial markets. The big question is always, but Rudy, where does that take us for the years ahead? And I honestly, I can't give you any certainties or ironclad forecasts in that perspective. But what I can tell you is that there are two very opposing views about how this is going to play out over the next few years, and that those forecasts are summarized in the share market today. And it's essentially, as you can tell from this chart, is essentially opposing Magellan versus Platinum. And I still remember the times when Platinum Asset Management was regarded as the local Buffett we had in Australia. And on my observation, today almost nobody is paying attention to Platinum anymore. And there's a very good reason for that. On top of the slides you can see there, I put the share prices of both companies. And you can tell that Magellan has had a jolly good time over the past few years, and Magellan, with the occasional sprint in the share price, has only gone lower and lower and lower. The difference is, and here are the two views, and this is obviously something that you should really take on board. The Magellan view is that this time is different. And I know these are very dangerous words, but I can tell you now, I've been saying this time is different for 5 years now. What Magellan essentially is saying is that we are still, we will come out of this recession at some stage, and that obviously will translate into an acceleration in growth. But once that effect is gone again, we will still be in a low growth environment, and inflation will be very, very hard to come by, and bond yields will remain low for a very long time. And in the meantime, we will have these mega trends on the back of some of the technological advances I've alluded to earlier. I mean, big data, cloud, data centers, online, driverless vehicles, electrical vehicles. I mean, the future is absolutely going to be very, very different from what we knew it was only 10 years ago. And in the meantime, also because we are in a low growth environment, a lot of disruption happening, investors will pay up for quality and for certainty. So don't think that a share price of CSL, for example, today is expensive. It's not. It's actually on my assessment, CSL share price is a steal today. Equity valuations will be structurally higher if you adapt that view, and that's is sort of the view what I'm leaning towards as well. Although we can't be too certain and too naive in these things, and the financial markets can always surprise us at any given point. The opposing view, which is amongst many value investors, including Platinum, is that this time is different, is a very dangerous forecast to make. They're saying it's never different. So what they are waiting about is the return of inflation, and that it will come because governments and central banks are putting so much stimulus in economies that it will lead to higher growth and thus to higher inflation. And ultimately, that will also lead to bond yields moving a lot higher. Last time we saw a little bit of this happening was in 2016. And at the time, I thought the financial markets were going crazy. I thought you guys are really smoking something I'm not aware of. And we had a very brief but very violent change in dynamics in equities, because the world started to anticipate exactly this scenario, and it lasted the grand total of 5 months at the time. They are also the guys who will tell you that we are in bubble territory and that share prices today are very much comparable to the year 2000, and we all know what happened back then. I believe there are pockets in markets, in particular in the US, where that is definitely true. I'm not so certain whether that can apply to equities in general, but as always, the proof of the pudding will be in the eating of it. Then we come to one of the final slides I'm gonna show you today. How have I personally been navigating the treacherous circumstances in financial markets over the past few years? Probably good to point out here that I'm not your typical growth investor. I'm very much leaning towards quality, and I've learned to appreciate the value of quality post GFC, and my analysis and research very much gives me more and more evidence as time goes by. But I do understand growth a lot more than I do in value, and I often tend to underestimate value, because shares can be cheap, but it doesn't mean they're going to perform for you. And so I've basically, my universe and in the portfolio I run, I've cut the share market in 4 baskets essentially. And the 4 basket is the one. The first basket is the one on top. It's the highest quality stocks we have in the share market. They are not affected by the many changes taking place in society, or in some cases they're even benefiting from it. And you have to think about stocks like CSL, Technology One, NextDC, Car Sales, REA, and others. And I'm a big fan of owning those stocks. Probably one of the major things I've done over the few years is convincing investors that because it's on a high PE doesn't make it expensive. The second group, and I do believe that they are an integral part of a successful long-term investments portfolio and strategy, is that you have to find solid, reliable dividend payers. And apart from some of the industrial stocks where you could, for example, you could add an MCOR or an IRIS in there. There are obviously the more traditional dividend payers, and I've shown you the list of that. Then in basket number 3, we have the technology companies that are the emerging disruptors. And I'd like to point out that not every technology company is a disruptor. For example, I mentioned Technology One in the first basket and not in this basket. But in this basket, we do have the names on the share market, and some of them have become incredibly popular on the stock exchange this year. Think about Afterpay and Zip, for example. Personally, I'm a big fan of a stock like Zero, and I think we should all have a good look at stocks like Phineas, for example. Basket number 4. See, those are the ones I have been avoiding like the plague over the past decade, and that has served me incredibly well. And those are the companies. The big difference, which I didn't mention before, but which is worth highlighting here, is that when the world went through gigantic changes in the 1920s, it didn't so much affect old sectors and old economies as it created new employment and new sectors. The difference today is that whatever is coming as new is impacting on whatever is there in terms of old. And so providers of credit, which is including the banks, retail, I mean, some of the retailers are having a good time today, but there's serious question marks about the longevity of it, and the move to online is unstoppable. Including wealth management, media, telecom, and other traditional sectors. There are very good reasons why buying cheaply has not returned very good returns for investors over the past few years. And this, in my view, is going to take a long time unless we get a change towards the platinum asset management view of the world. Closing remarks. I mentioned a couple of times. I do run what I call an all-weather model portfolio. It's based on my research, and it has performed quite well. And for everyone who would like to read a little bit more about my analysis of the market and about investing, I've curated a secret report which you can access by just putting /secret after the website address. I haven't updated it for a while, but I will update it next month. So if you download this one and you come back after a month or two, you can download another one which will be of different content. And having said all that, I hope you liked it, and I gave you enough to think about and to challenge your ways of how you view the market. And I am open for questions starting now.
Okay, thank you, Rudy. I'll just get to my correct screen here. Okay, we'll now begin answering the questions submitted during the presentation. As a reminder, you can still submit questions through the questions pane in your attendee control panel. Once you leave today's webinar, you'll receive a follow-up email with a link to view a recording of today's session. Handouts and other webinar recordings are also available on the ASA website within 24 to 48 hours at the conclusion of the session. On behalf of the ASA and our members, thank you for your time today, Rudy. So now let's go forward and have a look at some of these questions. So if I can just find those for you. We'll start off. Rudy, do you have a view on the US dollar?
Other than that, it was Greenspan himself who said that if you want to forecast the US dollar, just throw a coin and go for heads or tails. What we have to realize is that once we come out of this global recession successfully, the US dollar is more likely than not will weaken because growth elsewhere in the world will pick up and the central bank in the US will still be providing stimulus. So if we come successfully out of this, we should be faced with a weaker US dollar, which should help companies and markets perform in emerging markets, Europe, and in countries like Australia. Although Australia might have the complication that will push up the Australian dollar, and that will then feed into that narrative that the value investors, which are the local cyclicals, for example, might then outperform the foreign owners, the foreign earners, like a CSL, ResMed, Aristocrat, etc. If we have stumbles along the way, and for example, we're having a stumble this week, you should always expect the US dollar to strengthen, and that's exactly what we're seeing this week, for example. So you simply have to, for the time being, you have to understand that dynamic, and it's all now about are we going to get successfully out of the recession that we're having this year, and what is the timing and what is the speed by which we do this. And relating to those elements, you will see a much stronger US dollar in case of failure, or a much weaker US dollar in case of success.
Okay, so given that position on the US dollar, and obviously we're in an election year and we get a result of the election in the US in early November, how do you think the China and USA trade situation will play out going forward after the election, and how will that affect investing in Australia?
One of the characteristics I put forward is that we have now this rivalry that is. And I already said years ago that we should not see that as a temporary element. That this is going to not denominate. This is going to dominate the world in the decades ahead, plural. Now, hopefully, we will do this without having two world wars like we had last century. Let's hope that's the case. But we are increasingly, and I hope everyone is picking up on this, we are again increasingly steering towards a polarizing view of the world, and we will get a China zone and a US zone. For what it's worth, if I step outside of my investment clothing here, I did study political science, by the way. I don't think the US is doing themselves a lot of favors by going isolationist and alienating their traditional partners in Europe and elsewhere. But that's by the by. I do think that irrespectively of who wins the election on November 3, we will have increasingly a standoff between the US and China, and it'll be friction and potentially more for the next decade to come. And ultimately, it is all about who is going to dominate tomorrow's technology, essentially. And you see that with Huawei, with electrical vehicles, and with mobile phones. What we are probably not aware of is that the Chinese, by now, in many ways, have the superior technology. It's just that obviously makes the US very afraid that they might be at risk of losing their position in the world, and that is part of the reason why we're seeing what we're seeing.
Okay, thank you. Turning to QE and current monetary policy, given the amount of money that's being pumped into the economies by governments, is money being debased or devalued? And if so, what is the impact on thinking about buying shares?
This is an incredibly complicated and convoluted matter. Economists are being forced to rethink their traditional approaches, and very few understand really the impact and what is exactly happening in the world. This is why you and I seldom see references being made to things like liquidity and and etc. And it's always still everyone's talking about the correlation between economies and financial markets. In a very simplistic matter, economies have changed dramatically over the last 100 years. It's no longer about manufacturing and building things. It's very much about what's happening to credit and how much of it is available and how it will find a place in society. And of course, I mean, there's that. I'm not so sure whether currencies are being debased, because ultimately everyone is in it. I don't think that if you see charts whereby the Bank of England and the Bank of Canada and the Federal Reserve are using their balance sheet, that those charts should not include the Bank of China, which is essentially in on the act as well. So it's a very, very difficult matter that most professors probably won't be teaching at university. Maybe in a simplistic way, I can tell you that Bitcoin is as much a result of today's abundant liquidity. It probably is the share market and gold, and the way that's going to interact and create inflation or not, or a cheaper currency. I'm still waiting for the US dollar to collapse, and those predictions have been made repeatedly over many years. And as I said earlier, the problem is that once the US Federal Reserve has gone the same route as the Japanese did, the rest of the world simply had to follow, and that basically has happened now. Are we going to see negative interest rates in Australia? Well, we are now at the point where we have negative bond yields, and it has arrived on Australian shores. How ultimately that's going to impact on the price of equities, I don't know. But I do know one thing, that those value investors that are very much afraid of too much debt and low bond yields and low inflation, they really have to be careful what they wish for, because if the dynamics that's supporting equities today will change dramatically, it will not save you from owning cheap equities. And I think we already saw a little bit of that in late 2018, when everyone was complaining that parts of the share market had become too expensive, and it probably had at that point in time. But when the downturn arrived, the cheap shares fell as hard as this expensive shares. So there was no hiding there. And earlier in this year, we saw the same dynamic playing out again. In that, actually, the shares I own, and they are not in the cheap category, they would not fall as hard, and they would recover much quicker. And that, I think, is one of the lessons that investors should take on board. Don't count on the system breaking down, because if the system does break down, you do not want to be in equities, full stop.
Okay. You mentioned iron ore producers. So the obvious big ones there for Australia, BHP and Rio and Fortescue. How tied are they to the outcomes in China? I mean, are they just, is their position solely dependent on how well China goes, or do they have other opportunities for growth?
No, it is in a very simplistic form. China produces as much steel as the rest of the world, and that gives you everything you need to know. If the Chinese just look at what has happened with, for example, with meat, with barley, which might happen with infant formula, with wines. If the Chinese had any chance of punishing Australia through iron ore, they would have no doubt of doing it. The problem is they can't, and in particularly not when Brazil has problems with supplying China. So the Chinese would be incredibly frustrated that one of the ways of keeping their economy humming is by keeping construction up, and construction still requires a lot of steel, even though they are moving to a phase where they are increasingly able to recycle old steel, like we do in all developed economies. But there's still a gap there, and the only way to fill that gap is by producing new steel. New steel requires iron ore. Australia has the highest quality iron ore, and apart from that, there's not enough iron ore around. So and it's constantly that question mark when more iron ore will come around. Iron ore is essentially an infrastructure project. It's not like gold. I mean, you and I can open a gold mine tomorrow, and we just have to find a few nuggets a day, and we can keep the whole thing running. With iron ore, it doesn't work like that. You need billions of dollars. You need train lines and etc. And so it's a very long lead time for projects. And then still, if you can't just scrape it off the earth like you can in the Pilbara, you're most likely looking at an inferior product at a higher cost, and that basically is sheltering the Australian producers. It won't mean that iron ore will stay at the current price forever and ever, but it can stay high and high on a historical basis for quite a while. And I think we are at the moment in an exceptional time. Iron ore is very high priced, and there's not enough supply around. Those dynamics will change over time. Exact timing is always uncertain in these things, but it would appear that for the time being, and we're talking the next 12 to 18 months, iron ore price should remain relatively high, which means an abundance in cash coming the way of the top of the Australian producers, which means they can pay out a lot to shareholders.
Okay, thank you. Now, we've gone slightly over time, so we'll just ask two more questions and then we'll close off. A question regarding the Australian Big Four banks. So they a buy, a hold, or a sell at the moment?
I'm not avoiding the issue, but it depends on what you're after. I mean, I said earlier that the recovery from this year's damage will require a long time. We're talking years, multiple years. With the exception of Commonwealth Bank, all the banks in Australia are cheaply priced. I don't think there's any analyst out there that will question that assessment. The only problem is that's all you know at this point in time. It doesn't mean that undervaluation, which is an estimated, let's call it 20-25% at this point in time, that will be filled up quite quickly, and probably won't. The big question mark for Australian banks is the impact from this year's recession is yet to come, and that'll be a next year story, year-end next year story, and the market will definitely be looking towards like how is that going to play out. We might still see a lot of bad news coming towards the banks next year. No growth, not enough investment over the years, and if you look at the scandals that are coming out, and they are coming out, keep on coming out, they are not well managed companies. The banks peaked in April 2015, and that basically sealed off that era. They will have to reinvent themselves. They will have to make a lot of investments, and they will have to find growth again. That's going to take a while. So yes, you can buy them here. You'll buy them cheaply. Doesn't mean they can't get cheaper, and it will require that you will have to be patient. My analysis from the banks, and this is based on decades of data and analysis, is that if you want to play the least risky and the most certain outcome, you always buy Commonwealth Bank. You ignore the others. And Commonwealth Bank is by far the superior bank in Australia, and will show that over time and again.
Okay, thank you. And the last question before we close off today, regarding Telstra, you talked a little bit about that during your presentation. Do you think 5G is going to make a difference to it and give it any sort of impetus to revive the company?
Well, I think I might not have been clear enough earlier. I think it's very simple. I think Telstar is going to cut itself in pieces and it's going to sell off the farm. Whether that's going to be in 3 pieces or in 4, we still have to see the outcome of that. But I truly believe that the board of Telstar is now come to the realization that they cannot do it. They can't. I mean, there's too much working against them. There's too much legacy assets. There's too much of a ball and chain around their ankle. And what we all have to realize is that even though they had to cut their dividends already a couple of times, they will have to cut the dividends again. That's a given. The only that's not given is the timing. They are receiving, as part of the copper wires they sold to the NBN, they are receiving billions of dollars each year from the NBN. I think that's going to stop in 2 years' time. Again, when that stops, the dividend will reset again at the lower level. So what you effectively see is that an asset that was brought to the market, what was it, $9? It was $7.40 in 2001, I believe. That was tranche 2. That is today trading at a third or less of a third of that, and the dividends, of course, have been cut along the way, and they are unsustainable. Right? So will Telstar save themselves in 5 years' time? The answer is a resounding no. I think that in 5 years' time, Telstar may A, no longer be around, B, may look a lot slimmer than the way it looks today. Ironically, that is probably going to unlock some value for shareholders. The reason I think why the board is going down this route is that the sum of all the elements apart is probably going to be worth more than keeping them all together under one umbrella.
Okay, thank you, Rudy. Now that's the last question that we'll ask today, given that we've gone over time. So I just want to make a couple of comments here. Firstly, thank you, Rudy, for your time today and answering those questions for us. An excellent presentation. On behalf of the ASA and our members, thank you very much. To everyone, thank you for joining us today, and enjoy the rest of your day. Before you go, I just want to mention to everyone about the upcoming virtual conference that the ASA is going to be conducting. This is going to be on the 10th and the 12th of November. So go to the ASA website for details of that. And for the ASA members, you can sign up with your ASA membership code for a reduced entry price. So there's more details on that on the website. So for everyone here today, thank you, and all the best, and have a good day. Thank you very much.